Good evening. My name is Paul Kaufman, and as the Dean of the Faculty of Business and Economics, I'm absolutely delighted to welcome you here tonight to the 73rd Annual CPA Australia University of Melbourne Research Lecture. In our customary way, I would like to acknowledge the Wurundjeri people of the Kulin Nation, traditional owners of the land where tonight's lecture is taking place. I would like to extend a very special welcome to the National President of CPA Australia, Mr. John Cale, as well as the Victorian President of CPA Australia, Mr. Paul McInerney, and members of CPA Australia gathered here tonight. We are also joined by colleagues from the profession, industry and academia, some of whom have travelled from interstate and abroad. I would therefore like to welcome all delegates from the CPA Congress, members of the university and of the profession, and the general public gathered here tonight. It is heartening to see so many of you here this evening, and I thank you for contributing to and maintaining, through your attendance, a long-standing tradition of what is the longest-running lecture series at the University of Melbourne. It is now 72 years and 5 days, to be precise, since Sir Alex Fitzgerald, a pioneer in accounting research and education, delivered the first annual research lecture in this series. Not too far from here, in fact, in what was then the new Commerce Theatre. Each and every year since then, a sequence of highly esteemed researchers and thinkers in the field of accounting have continued to present new ideas, findings and knowledge, and tackle challenging questions on a range of topics at the forefront of accounting research. When the lecture series was established, its aim was to promote and stimulate research and encourage original contribution to accounting. I'm very proud that through the strong partnership between CPA Australia and the University of Melbourne, this vision continues to be promoted to this very day. In keeping with the series' strong reputation for involving those who have been highly recognized in shaping modern accounting theory and practice, the presenter for this evening's lecture will be Professor Naomi Soderstrom of the University of Melbourne. Professor Soderstrom is an internationally renowned and widely published researcher specialized in managerial accounting and environmental accounting. We are very honored to have Professor Soderstrom presenting here tonight, particularly as this occasion also marks her inaugural professorial lecture at the University of Melbourne. Before I conclude, I would like to note that this public lecture is being filmed for university purposes, and that any questions you may ask at the conclusion of the lecture will be recorded. You're just warned. Dear guests, I'm very pleased that Naomi is here with us tonight to give the annual lecture, and I will now ask the head of the Department of Accounting, Professor John Lyon, to come forward to introduce her.
Great, thank you, Paul, and good evening, everyone. Well, it gives me great pleasure to introduce tonight's speaker, Professor Naomi Soderstrom. Naomi is a research scholar of tremendous standing in the field, particularly in the areas, as Paul mentioned, of managerial accounting and environmental accounting. And we, of course, are very grateful that she's able to present this lecture tonight, the 73rd CPA Research Lecture. Naomi received her PhD in Accounting and Information Systems from Northwestern University in Illinois in the US and has gone on to a distinguished academic career. While much of Naomi's work looks at decisions related to cost structure within organisations, particularly within the healthcare industry, she also maintains broader research interests and holds a strong publishing record across areas including IFRS adoption and accounting in the context of corporate social responsibility issues. She is an active member of the American Accounting Association and serves on the editorial boards of no less than 5 major accounting journals. Professor Soderstrom has previously taught at undergraduate, master's, executive and doctoral levels at the University of Colorado at Boulder, the University of Washington and the University of Colorado at Denver, largely in the areas of managerial accounting and control systems. She has presented her research internationally at various institutions throughout Europe, Asia, and North America. She has also been a visiting scholar at various business schools around the world, and we in the Department of Accounting are now particularly fortunate to have Naomi join our ranks as a teaching and research academic. Throughout her academic career, Naomi has been had a particularly strong interest in the emerging area of sustainability accounting, and it is on this area of expertise that she will draw in tonight's lecture, which will trace the development of sustainability reporting through past, present, and the future. So now, to present the 73rd CPA Australia University of Melbourne Annual Research Lecture, I'd like to invite to the lectern, and would you please warmly welcome Professor Naomi Soderstrom.
Thank you for coming tonight and allowing me to share my thoughts on sustainability reporting. It's always kind of a challenge to have a topic like this, particularly with a word such as sustainability in it, because sustainability means something different to everyone that you talk to. And so I want to be clear that I'm not talking about if companies are sustainable. Should they be sustainable? What I want to talk about is how they report about their activities related to sustainability. So what we're finding over time is that companies are facing increasing pressure to disclose a lot more about their activities related to sustainability. And as a result of that, what we're finding is that there's an evolution of how they're doing their reporting. And so that's what I'm going to be focusing on tonight. So for my agenda, and I want to thank my husband for helping me with the animations tonight to keep you entertained when my comments are less entertaining. What I want to do tonight is trace the history of sustainability accounting, starting from early 1900s through to today. And what I want to do is, obviously I don't have time in 30 minutes to go through all of the details. I want to give kind of a broad overview of how this type of reporting has evolved and where it's heading. And then what I want to do is talk about integrated reporting, which is, according to many people, sort of the next step in what's going to be happening with corporate reporting. So I want to let you know what it is, and I want to then take a look at some insights from research to help us think about, is integrated reporting really the way that things are going to be reported in the future? Or is it something that's a nice idea but really isn't going to be feasible in at least the short to medium term? And then I'll step out of my comfort zone as an academic. We don't like talking about the future. We like studying the past a lot more. But I'll give you some ideas of how I think about what's going to be the future of corporate reporting in this area. So I'm not going to be talking about sustainability, but I do think we need to have at least some level of definition. So here's what I mean when I talk about sustainability. What I'm going to do is equate the terms sustainability and corporate social responsibility. So here's a definition from the European Commission's policy on CSR, corporate social responsibility. Enterprises should have in place a process to integrate social, environmental, ethical, and human rights concerns into their business operations and core strategy in close collaboration with their stakeholders. So these are basically the dimensions that we're going to be talking about as being covered in corporate sustainability reports or CSR reports. And what we'll see is that over time, not all of those aspects of CSR have been covered in the reporting that we've seen in companies. So I'm not going to have an exact timeline, but I'm going to give you a notion of how corporate reporting has evolved over time. So the way that I think about it is that corporate reporting is a reflection of society, and it has waxed and waned depending on what is important to society at a particular point in time. So if you look at going back, starting around 1900s and working way through to probably around the 1960s, there was a lot of focus on employee reporting. And if you think about what was happening in the world, as we were industrializing, there were a lot of issues associated with labor. And so that really became the focus of reporting about corporate social responsibility issues. So we see a lot of disclosures about human resources. There were studies that were done in Australia looking at, for example, BHP's disclosures starting in 1885 all the way through 1994. And these researchers basically counted up the number of pages that were spent on different topics. And what they found is in the case of social responsibility reporting that the vast majority of pages were spent on human resource types of issues. Now, they didn't look at the content. This was done by another set of researchers who examined U.S. Steel disclosures in financial statements over the period basically from 1901 through 1980. And they also found that there was a huge focus on human resources kinds of issues, particularly looking at things like dwellings that were being built for workers, community development, worker safety kinds of issues, mortgage assistance programs. So once again, I think this was really driven by what was going on in society at the time. Now, a lot of the disclosures that I'm going to be talking about until pretty much the latter part of the 1900s was all in financial reports, in the financial statement itself, and not in a separate CSR type of report. So as reporting about just employee issues started to decline a little bit, it was replaced by social reporting. So here, if you think about what was going on in a lot of the world in the 1960s and 1970s, there's a lot of social upheaval now. I was in the United States at the time, so I guess my focus is a little bit more there. But I think back to the 60s, and I think about things like feminism coming into play. I remember things like a lot of equality of races types of issues. There were wars that were very unpopular. We had the Cold War that was very much in societal focus, and I think that was true not only in the US, but in other parts of the world as well. And so the kind of the social mindset was much broader than just looking at issues associated with employees. We did see some material on environmental issues at this point in the history, but really the focus was more on the social aspects. So this peaked in about the 1970s. It was still in the financial statements primarily. There was a study by Ernst & Ernst, which is the precursor firm, one of the precursor firms to Ernst & Young. And they did a study, and they found that only 1% of the Fortune 500, so the top 500 companies in the U.S., had a separate social report. All of this information was being reported actually in the financial statements themselves. So that was only about 7 companies that had a separate report. So as we'll see over time, and as reporting has matured, that number skyrockets. So things kind of died down after the 1970s. There were some economic issues going on in many parts of the world, in the United States and in the UK. We had a much more swing toward more conservative governments with Thatcher and Reagan, and there was a big push toward deregulation. And so what we found is that there was less pressure on companies to be forthcoming about these kinds of issues. And basically, the level of reporting dropped off significantly. And so there were some exceptions. Now, we had development of some types of companies that essentially had a social agenda. So you're probably familiar with the Body Shop. I was walking to the office this morning and saw a sign for Ben & Jerry's, so I know Ben & Jerry's has made it here. But these companies had a very social orientation in the way that they were doing business, and basically their business model had what we now call sustainability at the heart. So doing good things for the environment, doing good things for society, doing good things for their employees. Now, this was a beginning of a phenomenon, particularly in the mid-70s, and it started out as being a pretty small group of companies. So they continued to report into the 80s, whereas in general the other types of companies were pulling back on the types of reports that they were doing. So in the late 1960s, 1970s, 1980s, we started having some environmental catastrophes. And I think that this instigated a lot of interest on the part of society in the environment and resulted in additional demands on companies to provide disclosures. So what we see happening is in the 1990s a surge of environmental reporting by companies. So this was a result of, as I said, environmental disasters. So some of the ones that really had an impact, and I guess with the increase in the availability of television, we now had vivid pictures to go along with the news about some of these things. So in 1969, for example, there was a river in Ohio in the United States called the Cuyahoga that caught fire. So imagine a river catching fire. And it happened multiple times. And the flames were shooting up 5 stories high. It took them days to put out the fire. And the cause of the fire was industrial waste that was being dumped into the river. So this became a huge issue in the national consciousness in the United States. And there was even a song that was popular on the radio at the time by Randy Newman about the burning river. As a result of some of these environmental catastrophes in the United States, at least, there was beginning to be some legislation to try to check the behavior of companies. So in the United States in 1970, we had the Clean Air Act. In 1972, we had the Clean Water Act. And these started imposing penalties on companies for not being good from an environmental standpoint. And there were similar kinds of laws that were springing up in other parts of the world as well. A huge environmental catastrophe that had a lasting impact, and actually it was in the news again just recently, was the Bhopal chemical leak in 1984. So there was a chemical release, and there hasn't ever been a precise estimate of the damage related to the chemical spill, but I've seen numbers that there are, if you not necessarily right away that people died, but over time, that there are about 20,000 deaths that are related to the Bhopal spill, and there are 600,000 people with permanent physical damage as a result of the spill. So this was immensely bad publicity, not only for Union Carbide, which was the company that was operating the plant, but for the chemical company as well, for chemical industry as well. And so what we see happening is that after seeing things like the Clean Air Act and the Clean Water Act, chemical companies, not only in the US, but in other parts of the world as well, got worried. They were worried that there was going to be a huge amount of regulation that was going to be foisted upon them, and so they decided to do some self-regulation. And so in the chemical industry, they came up with this program called Responsible Care. And so this was the chemical industry standing up and saying, look, we know that we've been bad, we want to take responsibility, and we want to do much better for the environment. So Responsible Care actually started in Canada in 1985, which was a year after the Bhopal spill. And at this point now, today, there are 50 chemical industry associations worldwide that have signed on to Responsible Care. But so now the chemical companies were really interested in demonstrating that they were being good stewards of the environment now, even if they hadn't been in the past. And so the amount of reporting that they provided in their annual reports increased dramatically. Bhopal had an additional impact in the United States in particular, and this also had ramifications worldwide. So pretty much directly as a result of the Bhopal spill, in the United States, the Congress passed a bill called the Emergency Planning and Right to Know Act in 1986. And this was a really interesting act because it wasn't penalizing companies for harming the environment. Basically, it was a reporting kind of an act. So there were about over 300 substances that companies now had to report to the government, and this information was made available to the public. And since then, there have been similar kinds of laws passed in other parts of the world. In Australia now, a lot of companies are required to report toxic releases. So the idea was that if companies are forced to admit to these things, and these are all legal emissions of things, it's not that they're illegal, that society is going to take note and put pressure on companies to reduce their emissions. And it turned out that in the first year of disclosure from the Toxic Release Inventory, the TRI, companies in the United States admitted to approximately 1 billion kilos of these substances that were being emitted into the environment. This was so much larger than anyone had anticipated, that there was a huge amount of press about the magnitude of harm that companies were doing to the environment. And so companies got busy and tried to reduce their reported releases. And over the next 4 years, releases dropped, at least reported releases dropped 35%. Now you can argue about whether it's because they changed their reporting methodology and how they calculated the releases, but if you look over time, toxic releases have really come down quite a bit in the United States. So in general, what's happened as a result of these environmental catastrophes is that disclosures have gone up. So after the Exxon Valdez spill, oil companies started increasing their disclosures from an environmental perspective. And then there's been research in Australia as well that has linked kind of the social consciousness and social concern about environmental issues to increasing environmental disclosures. So by the end of the 1990s, worldwide there were about 500 companies that were now providing separate environmental reports. So you can see that there was a huge change in the nature of reporting. Now, the nature of reporting differed across country and across industry. So you had the more hard-hit industries, or the more, I guess, environmentally intensive industries like mining and utilities and oil companies being much more likely to have these kinds of reports. And it also varied from country to country. I have a study that looked at disclosures across countries, and depending on the nature of the legal system in countries, we find variation in the amount of environmental reporting. We also find variation based upon the amount of environmental legislation that's in each country. And other studies have found similar things. For example, that countries that have much more of a stakeholder orientation tend to have a lot more environmental disclosures. We also find that it's the wealthier countries that tend to have higher levels of disclosure as well. So in some sense, you could think of the environment as almost being a luxury good that you can have and protect when you've made it beyond subsistence. And there's been some theorizing about that over the years as well. So what's happened after environmental reporting is that in the middle 1990s, there was a consultant by the name of John Elkington who had a consultancy and think tank called Sustainability. And he came up with this notion of the triple bottom line. And what he said is that the problem with financial statements is that if you look at them, they only report on the economic results of a company, that they ignore other aspects that are really important to the future success of a company, namely their social and environmental impact. So what he envisioned was, instead of having a single bottom line, that being net income, that you would also have a bottom line for your social impact and a bottom line for your environmental impact. Now, conceptually, that's really nice. You could just kind of balance all of those three bottom lines. The problem is that it's not very feasible to do, because if you think about what you're measuring from a social responsibility kind of perspective versus financial perspective, it's very different kind of measures, and it's impossible to come up with a single number that is a nice summary statistic like net income. And so later on, Elkington stepped back a bit from having this very strict definition of triple bottom line. But the notion underlying the triple bottom line, the fact that companies should report on their social and environmental and economic impacts, remains today and has been incorporated into the integrated reporting that I'm going to be introducing later. So a sustainability report now is going to essentially address those aspects associated with the bottom line. And an interesting thing is that we want to have a balanced view, because as I'll mention later, the perception of a lot of the corporate reporting on things like environment or the social reporting that we saw earlier in an earlier time period was viewed as not being balanced. It was viewed as being biased. And so the idea behind sustainability report is you want to give a more accurate view of what's going on in the company. And so you need to include both the positive and the negative aspects of corporate performance. So all of the reports that we've been talking about, the social reporting, the employee reporting, the environmental reporting, all fits in here. It's just that this is more broad and incorporates all of those aspects. So this notion that we should be reporting on sustainability rather than just environmental health and safety kinds of issues has appeared to really catch on in companies. So KPMG, one of the major accounting firms, has taken over the surveys from Ernst & Ernst, now Ernst & Young, and has a series of surveys that trace corporate sustainability reporting. And in their 2005 report, they noted that after 1999, the focus, or the title even, of these reports put out by companies shifted from being environmental health and safety reports to being called sustainability reports. Now, they didn't do an analysis of all the reports to see what the differences were. All they noted was that the titles were different. So in 2002, for example, 70% of the reports in the Global 250, so these are the biggest 250 companies in the world, 70% of them were called environmental health and safety reports. By 2005, 70% of the reports were now called sustainability reports. So at least in name, we see a shift toward more sustainability reporting. And the number of reports, a number of companies that are reporting also increased dramatically. So in 2005, 64% of the Global 250 were providing these kinds of reports. In 2008, 80% of the Global 250 were providing these reports. So we see a huge increase, and actually if you look at the curve, it's kind of exponential in terms of the number of companies that are providing these kinds of reports. So the next evolution, or the next round that's been proposed, is integrated reporting. And integrated reporting is a development of two groups. The Global Reporting Initiative, which I'll discuss a lot more in a few minutes, and the Prince of Wales Accounting for Sustainability Project. So these two groups got together and said, look, we really want to have a single report that covers all of these things. We don't need a separate financial report. It should all be integrated into one report. So I want to focus on the bottom part. See if I can get this. Yeah, the bottom part of this definition. So basically, it's a sustainability report, but it provides a clear and concise representation of how an organization demonstrates stewardship, how it creates value now and in the future. So if you think about what this means relative to just a report on my performance, a report on performance is really very backward-looking. And we tend to think of financial statements as being backward-looking. We're reporting on our performance over the past year. Well, now here with an integrated reporting, what they want to do is have you, first of all, talk about your strategy, how you're creating value, and project it into the future. So this is a very, very different role for corporate reporting than we've had in the past. And there are a lot of implications of that. There is an underlying agenda in integrated reporting, and if you read their literature, they want to make companies more sustainable, and they believe that by forcing them to do integrated reporting, because you have to include information on things like your strategy, how you're creating value, how you're being a good steward, that you're going to end up being more sustainable. Now, you can agree with that or disagree with that. It's just, that's what integrated reporting is. It's going beyond the notion of providing information to decision makers and trying to, in some sense, socially engineer what companies are doing. So if you look at what's happened with integrated reporting, KPMG's 2008 survey indicates that 3% of the Global 250 now claim that they're doing integrated reporting. Now, there are no standards yet, and we'll talk about where those standards might be going, but 3% are claiming that they're doing a fully integrated annual report. Now, this is not just isolated companies. In South Africa, the Johannesburg Stock Exchange now requires companies that are listed to either provide an integrated report or explain why not. So it's going to be interesting to see what the implications of companies explaining why they aren't doing this is or are. So it's just started. It was fiscal years, I believe, starting in March 2010. So we really don't have enough experience with the required integrated reporting to figure out exactly what the implications are. And we don't know what the integrated reports look like. So they say that you need to integrate it, but as we'll see, there aren't standards. So it's going to be interesting to see what these things look like. So I want to give you an example of what one of these things look like. So the company that I've chosen to show you is Novo Nordisk, and it's a Danish pharmaceutical company. And the reason that I chose this particular company is their level of integration is very high. They also are kind of put forth as being a company at the forefront of integrated reporting. So this is, in a sense, state of the art for integrated reporting. It's not the only model. There are many models out there, but it's going to allow me to illustrate some of the aspects of integrated reporting. So Novo Nordisk is a world leader in diabetes care and has a leading position in hemophilia treatment. They do growth hormone therapy and hormone replacement therapy, and they have some additional development projects. It's a large company. They have 32,000 employees, and they're pretty global. They operate in, they have employees in 75 countries. So let's take a look at what their model looks like. So this is basically the table of contents from their integrated report, and I'm going to blow some things up to help you see this because I realize in the back this might be kind of small. So if you look at the qualitative types of disclosures that they're including in their report, a lot of them would look familiar, but there are some differences. So for example, there's a discussion of triple bottom line management. So this notion of triple bottom line, you can see, has gone through into integrated reporting. The other thing to note is, and I'm not sure the grammar is correct on this, but basically what they're claiming in the other box that I have blown up is that a lot of the information in the report has pointers to underlying reports and other information for the company. But what they're careful to say is that that information is not part of the public filing. And this is for regulatory reasons and for auditing reasons, because if it is part of the public filing, then you're going to have to audit it, right? So you'd have to go really deep in the organization to get at all of this information. So another feature of integrated reports is that they have key figures. And so the thing to note here is that the top, which you may not be able to see very well, the top is basically an income statement. So financial is still important. But what they also include are these additional aspects as part of their key figures. So we've got long-term financial targets, social performance, long-term social targets, environmental performance, and long-term environmental targets. So you can see the different aspects, kind of the triple bottom line notion, and the fact that we aren't just focusing on the short term, we're also now looking ahead to the long term as well. So let's take a look at what these statements look like. So this is the table of contents essentially for their consolidated statements. And notice that they're in a sense treating the social and environmental statements at almost the same level as the financial statements. So they do note that they've got consolidated financial statements, a consolidated social statement, and a consolidated environmental statement. And I think that the supplementary information is because of statutory requirements that an integrated report is not required for Danish filing, and it would be counter to what's required. But what they're trying to get at is that the social and the environmental should have equal stature and should be viewed very similarly to the financial performance. So here's their social statement, and before I blow anything up, in this diagram, if you look at it, it looks a lot like a financial statement, right? It's got kind of the same format that you might expect in a financial statement. But the contents are a little bit different. So it's going to be difficult to read, but if you look at some of the indicators, you can see what they're focusing on. So they've decided that patients, employees, and assurance are really the important areas of social responsibility that they want to report on. They've got measures in all of these areas, and you can see that in this column it says note. So these are references to footnotes, just like you would see in a financial statement where you've got further explanation of numbers that are put into financial statements. And the main difference is that these don't accumulate. So you think of a financial statement that you start out with revenues and go through expenses and all those kinds of things and end up with net income in a summary number. This is more of a collection of different indices with different types of measurement. So for example, the engagement for employees, this engaging culture, okay, whatever that means. What they've done, if you look at the footnote, is they've got an annual employee survey. And they've got 8 questions that they ask employees, and the employees rate things on a scale of 1 to 5, and they average those scores, and then they average it across employees. And so that's what they're reporting. Now, they also note that the number of questions that they've used has changed in the last year. And so in terms of being able to compare last year's number to this year's number, it's unclear that you can do that very readily. The environmental statement's a lot shorter. And what it focuses on is releases to the environment, and it also focuses on compliance. And you can see that there's detail here on carbon. Now, once again, there's a lot of reference to footnotes. So, for example, you see total waste, which is just a big summary statistic. But if you go to the footnote, it talks about what percentage of the waste is recycled and going to other types of means of waste disposal. So there's a lot more detail that underlies the reports here. This is just the summary, but once again, it's not really like a typical income statement or balance sheet or something like that that we're used to seeing. So the question is this integrated report going to replace financial reports, the ones that we're familiar with? And what I want to do is as efficiently as I can, think about what is the nature of financial statements, how does it relate to what is the goal of integrated reporting, and see what kinds of inferences we can make. So when I think about financial statements, what makes them something that's credible for investors to use? Well, first of all, we've got a focused user. The user of the report, as I'll explain further, are investors primarily. The reports are based on standards. We've got international standards that we use to develop our financial statements. Everyone has to do it if they're publicly traded, and even some others, and they're audited. So let's take a look at financial statements relative to sustainability reports and look at what the research has to tell us about the differences. So financial statements, as I've mentioned, they're for external decision makers, investors, and creditors. The integrated report has a much broader set of stakeholders. So Novo Nordisk has identified its primary stakeholders, patients, but they also list healthcare providers, payers, employees, investors, suppliers, and other business partners. But you could also expand this, depending on what the company is, to NGOs, to communities, to regulators. So there really is a huge array of stakeholders that we're trying to give information to with these integrated reports. So what are the issues associated with these? Well, the ones that come to my mind are, what do the stakeholders want to see, and what kind of information would they use? So if you think about financial reports, what kinds of information do they want to see? They don't want to see a lot of methodology about, how do you calculate income, or how do you calculate revenues, or how do you calculate marketing expense. There's a level of literacy that is assumed when you look at a financial statement. So the Financial Accounting Standards Board in the US has the following quote, and it's very similar for IFRS, that they expect reasonable knowledge of business and economic activities and users who review and analyze the information diligently. So you have to know something, and you have to work a little bit to get at the information. Now, is that going to be true for all of the stakeholders for a sustainability report? Can you assume the same underlying level of knowledge and diligence in applying the information? Probably not. And even once you decide what level you need to disclose, the different stakeholders are going to have different requests. So if you think about something like carbon. So carbon, it seems to me, is, of all of the issues that might be covered in a sustainability report, as something that should be relatively easy to measure. And I know there's a whole carbon accounting. None of it's easy, but if you look at the array, carbon is perhaps one of the easiest. It's a substance, right? It exists physically. So why can't we measure it and report it? Well, it depends on the stakeholder. There was a study that where they interviewed different stakeholders for carbon accounting reports. They talked to scientists, and they talked to company accountants, and they talked to policymakers. And there were quite a few differences in what kind of information those different groups wanted. So if you think about scientists, they want to get down to the molecular level. They want to know precisely what the amount of carbon is. They want to know what the impacts are. They want to have very, very accurate kinds of measures. If you look at company accountants, what are they interested in? Well, they would like to have carbon commoditized because they want to be able to trade it perhaps and figure out how to manage their risk and make money perhaps off of carbon trading. And this is the case in some countries. They can do this. They want to be able to weigh the risks and benefits, and both in terms of the reduction in carbon against the monetary benefit across different types of investment alternatives. So they don't need to get down to the molecular level. They can have a more broad, less precise measure of carbon as long as there's an understanding of what level of precision it is, and then they can put it into their models. If you think about policymakers, they want to be able to spread accountability for carbon across countries, across companies, across even down to the plant level. So they want to have a very consistent measure of carbon so that if you make a regulation about carbon in one year, that the measurement doesn't cause changes next year that aren't reflected in reality. They want to be able to legislate based on some kind of consistent metric. And so which one of those groups do we aim the report at? In an integrated report, you would have to aim it at them all. And this is just one issue. And that's only 3 stakeholders. So you can imagine how big the report would have to be if you gave stakeholders all of the information that they would like to know in a form that they want. Even if you give it to them, are they going to use it? So historically, there's been research looking at whether investors actually use the information provided, primarily in environmental reports. And I'll talk about overall stock market reaction in a minute, but here I'm looking at individuals and what they use. So if you ask investors, what are the issues that are important to you? Environmental issues rank pretty low. They want to know more about the economics of what's going on in the firm, and environmental issues really aren't that important. And there have been some behavioral studies, some psychology-based studies where they have people making decisions looking at comparing companies where there is social or environmental information and companies where there's not. And it turns out that additional information doesn't impact the decision in any significant way. So behaviorally, we don't really see much. And in fact, there's another study that's recent where they asked people, what information do you use and where would you like to get it from? And a large majority said that they would prefer to get this kind of information from a third party because it's going to be less biased. So it's not even clear that if we have this information and we provide it, that it's going to be used effectively by the investors. And this is very costly information to gather, and if there's no benefit, then the question is, should we be doing it? This may be changing. If you look at shareholder activism, at least in the US, there's an increasing number of proposals by shareholders to get companies to report more. It's unclear how broad that demand is, although what we're finding is that an increasing number of these proposals are being supported by shareholders. Last year, the average was 21% approval rating for shareholder proposals related to sustainability disclosure. So this may be increasing over time, but at this point, it really hasn't hit a threshold yet where we see a really strong demand by individuals for the information. Do we have standards? Well, we know that we have IFRS for financial statements in the United States. We have US GAAP. For integrated reporting, there are some standards under development, but they're going to be quite different from what we've seen in financial statements. So issues associated with this is, first of all, are reports consistent? One of the reasons that we have financial accounting standards is so that you can compare companies to each other and across time. We have consistent reporting. So are we going to have that based upon the kinds of reports that we have now under integrated reporting or not? And even if we have standards, are they going to be consistent? Are reports biased? And then we'll look at aspects of CSR that are covered and how should items be measured. I'm going to look at those last two by looking at the current state of the art in terms of environmental or CSR reporting standards. So let me start with the first one. So are the reports consistent or are they biased? Well, there was a study in 2000 that was done in the UK, and they interviewed a lot of stakeholders associated with looking at these things, and they found that 40% of business and finance journalists thought that CSR reports were basically just PR. So just basically public relations exercises, and that really wasn't any information in them. And 31% of the shareholders that they interviewed agreed. So that's part of the problem, I think, that where we saw that they weren't using the information is because they don't believe that it really is very objective reporting. And we've seen lots of instances in the newspaper where we've got this kind of lack of complete disclosure in reporting. So, for example, Shell Oil was involved in some issues in Nigeria, in Ogoniland, and there were some huge spills, and they didn't get cleaned up over the years, and it finally was getting resolved, and in 2011, Shell was required to pay $1 billion US as a start to the cleanup. So this, to me, seems like it's a big deal. Well, if you look at their sustainability report, they have a whole page on Nigeria, but what do they say? Well, they say that the situation in Nigeria is complicated. So there really isn't complete disclosure. It seems to me that it's a little bit biased. Now, so what standards are going to do is they're going to help us define coverage and measurement, and hopefully make things a little bit less biased, but there still can be bias that creeps in even with mandatory standards because there was a study in 2010 that looked at annual report disclosures, and they found out that companies that were poor environmental performers were a lot more optimistic in their financial statement disclosures than were the good environmental performers. So the standards that have evolved, at least the lead standard is called G3. It's from the Global Reporting Initiative. And the Global Reporting Initiative is a consortium of a wide variety of stakeholders that have come together to try to figure out how do you develop standards for this. And they have some principles that they have for reporting. The top two are a lot like the things that you would see in the front part of a financial statement, the more qualitative disclosures. I'm going to focus on the bottom one, the performance indicators, because to me that is more closely related to things that we hold near and dear like income statements and balance sheets and things like that. An interesting thing about GRI on the bottom is that companies self-report their application level. These reports can get to be very detailed, very costly. And so at GRI, what they want to do is try to get companies kind of in the door and then get them to increase their amount of disclosure. So there are 3 different application levels depending on how in-depth your environmental reports are. And then if you have your report externally validated, you get to add a plus. So you have A, B, and C, A+, B+, and C+ levels. So let's take a look at some of the indicators. So there are core indicators and additional indicators in social and environmental and some other areas. So the core indicators are things that GRI thinks every company should be disclosing. So here are some examples: materials used, direct and indirect greenhouse gases, initiatives to mitigate environmental impacts, and then depending on the nature of your company, you might have some of these additional indicators. Now, the thing to note here is not necessarily what the individual measures are, but notice the variety in measures. And so once again, we can't really aggregate things very easily. So, but if you look at each of these measures, we can argue about them and say, what is the right way to measure it? So something like, let's start let's take a look at the indirect greenhouse gas emissions. Okay, this is, well, by having the lights on here, we aren't directly emitting carbon. However, the utility that's providing the electricity for us is emitting carbon, and so we need to figure out what our indirect contribution is. Well, how do you measure that? Well, there are some guidelines within GRI, but you still have a lot of options as to how you decide you want to report that. And so managers are going to have an opportunity, in some sense, to manipulate the numbers based upon the assumptions that they make, just like they do with financial information. So I may sound like I'm a little bit cynical here, but if you look at something as simple in accounting as revenue recognition, the U.S. Financial Accounting Standards Board and the International Accounting Standards Board have spent 10 years trying to figure out how to recognize revenue, and they have not come together. This is revenue, so how are we going to come together and have the same level of rigor in the standards when it comes to something like social impacts of a company? I think it's going to be very, very difficult to get standards up to the level that we expect as people who are users of financial accounting. Okay, is the report voluntary or mandatory? Financial accounting statements or financial reports are required. Integrated reports are not. They're voluntary. Now, there are some specific areas where reporting is required to governmental agencies, and in Denmark, for example, they've increased they've added some environmental reporting requirements to their financial statements. So in the cases where it's voluntary, the decision to report or not is very strategic. And we've had a lot of research in accounting looking at voluntary disclosure and the benefits and costs of it. And it turns out that in the accounting literature, companies that disclose more tend to have larger analyst following. They tend to have more accurate analyst forecasts. Their liquidity is better. So it could be a good thing to do additional disclosure. On the other hand, there could be self-selection, that the better companies are the ones that provide more disclosure. We also find in the accounting literature that when companies have bad news, they're likely to disclose it early. And this is, the idea is that they're going to limit any potential litigation associated with the poor performance or any negatives associated with that. Well, we find the same kind of thing when we look at disclosure of sustainability types of issues. So I want to separate performance from disclosure. Bad environmental performance is bad. Negative stock market reaction, et cetera. What I want to focus on is what does it mean when you disclose controlling for environmental performance. So I don't care if your environmental performance is good or bad, what does disclosure do for you? There have been two recent studies looking specifically at the GRI disclosures, and what they did is they came up with kind of a quality index of disclosure. And what they found when they tried to correlate the GRI index, so the quality of disclosures, with performance of the firm, they found a positive correlation. So controlling for performance, they found that more disclosure is better in terms of higher stock price, higher returns, and there's, across the two studies, there's mixed evidence about whether the cost of debt and cost of equity are lower. But in general, it seems to be a good idea. The problem is that we've got self-selection, because those are generally very big firms that are disclosing, so it's unclear what the answer would be if we broaden the sample to look at firms that are currently not reporting. And then finally, is there any objective assurance? Well, financial statements need to be audited. These integrated reports don't necessarily need to be audited. There's no requirement to be audited. And not only that, but there's no requirement for who does the auditing. So it could be done by accounting firms, management consultants, engineers, or lawyers. I taught an environmental accounting class in the 1990s, and I used Baxter International's environmental performance report. They had 3 audit reports. They had one from an accountant, one from a lawyer, and one from an engineer. So they wanted to cover all of their bases. So what are the issues associated with objective assurance? Well, you can decide whether or not to do it. And what we find is that in the 2011 report, KPMG found that 46% of the G250 had their reports assured. And it depended on the industry and the size of the company. So it was not random who did it. There were some systematic reasons why companies appeared to be having their reports assured. Now, what difference does it make? Does it matter who's assuring it if it's an accountant versus a management consultant? And I think this is probably of great interest to a large part of this audience. Well, it turns out that they're different products. So consultants tend to be more evaluative and involved in the process of developing the report, whereas accountants, we like to be objective and come in and examine things rather than being part of the process. It's part of our independence. And so that tends to be more what happens when you have an accountant auditing these things or assuring these things. I guess also the purpose that these different providers apply to what they're doing is different as well, because a lot of the consultants focused a lot on aiding the corporate strategic direction of the company as opposed to just verifying or assuring the report. So very different products. Now, do report users understand these differences or care? Well, it turns out that there's a different view depending on what country you're in. So there was a study that looked at people judging the credibility of assurance reports from consultants versus accountants. And they had subjects in the United States, Australia, and the UK. And what they found was that in the US, Americans cared. They found a difference between accountants and consultants and preferred accountants. And in the UK and in Australia, the credibility that was viewed by the different reports was the same. There was no difference. So it may be because of the nature of litigation in the US, or that we haven't had a lot of experience with these other kinds of assurance. So I want to just show you really quickly what these different reports look like. So here's a typical report. This is the opinion on financial statements from Novo Nordisk. And I want to just point out a few things. They used international accounting standards on auditing and additional requirements because they're Danish. They provide reasonable assurance, and in their opinion, there's a true and fair view of the firm given. So this should be familiar to many, many people in the audience who are involved in accounting, in the accounting industry. So let's take a look at what the same type of letter, the assurance letter, looks like for their social and environmental reports. Okay, so I had to block out a little bit more. So here we don't have the same kind of standard. So we've got AA1000 assurance standard, which has been developed by a consultant, so it's not officially sanctioned by any body. There is an international standard on assurance engagements, and so they did use that, but that's a very broad kind of a standard. And in fact, when some people involved in these assurance engagements were interviewed, some accountants, there were quotes like, "I have to say there's a general concern about whether we're capable of auditing the really important information and really important issues." And another one said, "There's so much room for interpretation." So it's unclear that the assurance standards that we have in place really are as effective as we would like them to be if we're providing information to investors. The nomenclature is also different. Notice this is limited assurance, not reasonable assurance. And they show what the limitation is, and it's because they were limited as to what they looked at. It's a very high-level kind of an audit, and so basically they want to be sure that they aren't held liable for things that aren't covered under what they were looking at. And then I like the conclusion. So this is the standard nomenclature, particularly for a limited assurance. Nothing has come to our attention which causes us not to believe that the consolidated information is free of material misstatement. That's, to me, is very different from the statement that something is a true and fair representation. So very, very different kinds of audits. So is this because of litigation concerns? It could be. At least I'm coming from the US, and so litigation is really high in my worldview. It turns out that in the KPMG survey, they looked at the number of restatements of the social and environmental information, and it turns out that 1/3 of the G250 issued restatements of their sustainability reports in 2011, which is fine. Some of them were they changed the way that they calculate things or something like that. However, about 1/3 of them were due to errors and omissions. So that's a lot particularly when you look at the error rate for financial statements, which is about 3%. And so the question is, if you're an auditor and you go in and you've got these errors that underlie the numbers that you're assuring and you're only doing limited assurance, what is your potential liability? And this could be an issue, although there is some behavioral literature that says that if the standards are kind of imprecise, that auditors may be somewhat protected from lawsuits based upon aggressive reporting, but that's very preliminary and tangential. It's not specifically related to this kind of reporting. Okay, so what's the future? Well, once again, I'm really uncomfortable doing this. This is not something that academics like to do, but what the heck? So I think that given what's going on in the society now, I think that that an increasing number of companies will report CSR information. We see a lot of indications that a lot more people are caring about this. Companies are going to be pressured to do this. I think that they will continue to produce multiple reports. I don't think that a single integrated report is going to be replacing the financial statements. I don't think that because of the measurement issues, the assurance issues, that we're going to be able to get the standards up and the reporting and auditing standards up to a level that investors are going to feel comfortable having just one report that goes through one form of audit. And I think that given the information age, that these reports will point to information underlying information within the company. But there's going to be a limitation, as we saw in Novo Nordisk, that not all of that can be audited. It would just be prohibitively expensive to do that. But I think that for some of the key elements that there will be audits, there will be assurance that's requested for the things that are critical to the organization. I think that overall disclosures in financial statements will increase. In the United States this year, they have created something called the SASB, the Sustainability Accounting Standards Board, and they're trying to figure out how to increase the amount of sustainability disclosures in 10Ks. Now, I have no idea what kind of success they'll have given what we've been talking about today. I think reports will become more standardized, but because the nature of social and environmental issues differs so broadly across countries, across companies, I don't think that they will be uniform. So I think the notion of having something like a financial statement that's comparable across companies is going to be very, very difficult to find. Thank you for your attention.
We have time for a few questions. We have a roving mic, do we, Stephen? There's our roving mic. Questions?
If a company dropped a bomb on Nagasaki...
I'm sorry?
If a company dropped a bomb on Nagasaki, they'd still be able to make that statement, wouldn't they? That I think what you used was something has come to our attention to cause us to believe the report is free of material misstatements.
Well, we have that. The audit is going to be confined to the things that they are looking at, and if something does not come to their attention, they can argue it. Now, the question is whether that's going to be credible and whether there could be subject to litigation is another issue. So if it's clear that they should have known, if it's something that's all over the place, all over the media, and it's not reported, and they claim that it's because it hadn't come to our attention, then that's going to be a harder argument to give.
But they'd still find something that was okay.
Well, they still found something. Well, this is like Shell saying, yeah, well, we have a complicated setting in Nigeria.
My name's Ted Murphy. Should the standards be based on a global basis, or should the standards be based on a country basis? That's the question. At the moment, with GRI reporting global initiative, that's based on global, but should it be based, the standards be broken down by country basis? and not looking at from one standard on a global basis?
Well, I think even if we end up with a global standard, that it will not be a global standard. So if you look at IFRS, and I'm sorry, don't say IFRS. If you look at IFRS, there are a lot of countries, there are hundreds of countries that have adopted IFRS. However, their implementation is different. So even if we have a global standard, it's going to end up being country-specific and company-specific.
Oh, hi there. Sorry, just a quick question. You've said that with the new sort of new regulations that have come in, like with the Water Act or the Clean Air Act, that's always been a knee-jerk reaction to like a natural catastrophe. What's it going to take, do you think, with so many climate change scenarios at the moment, for everyone to get on the same page and be like, right, okay, we actually do need to do something about this?
Well, I think that you're going to have stakeholders who provide pressure, and I think that hopefully it won't be that the environment gets destroyed or that there's genocide that causes it to happen. But unfortunately, a lot of this does tend to be reactive. Now, what we are finding is that there's an increasing movement to get companies to disclose when they should. So, for example, the Securities and Exchange Commission came out in 2010 saying, hey, companies, you're supposed to be disclosing climate risk in your management discussion and analysis, which is some of the qualitative disclosure in American financial reports, and companies were not. And they're saying, look, you've got the regulation there. It's the same regulation for any kind of risk. Climate change is a huge risk. It's clear it's going to be impacting your companies. You'd better be disclosing something about it. So it's partly having stakeholders like governments, regulatory agencies holding the companies accountable for these things. Hopefully it won't take a catastrophe to cause it to happen.
Anne.
Naomi, I was surprised that the audit report on the Novo Nordisk case, that there was any hesitancy at all on the part of the auditors, because I actually thought that in those disclosures there was nothing about impact at all. It was pure count data in the social responsibility report, the number of animals killed, the number of people involved in clinical trials. That could have been audited very accurately.
Yeah, one of the differences between in the audit levels for an assurance report is with a limited engagement, you don't look at the internal controls related to how the reports are being developed. And so they didn't look at the internal controls for that. So they didn't do as in-depth an audit as you would do for a reasonable level of assurance.
So their comment then about the no serious misstatements is actually, like, it's not even addressing the issue of whether there was any
That's
comment
right,
about
because
impact.
management defines the scope of the audit. That's another problem, is that in financial statements we know what the scope of the audit is. Whereas for these sustainability reports, management is basically saying, you know, here's what we think is important, and here are our reports, and the auditors are supposed to go in and they're supposed to think about have these the material issues been reported, but they aren't in the company. So to understand that fully is going to be pretty difficult for an external auditor. And let me just note on the social, since you brought up Novo Nordisk, an interesting fact is that it's a pharmaceutical company and they have a lot of lawsuits. And none of that's in the social report. However, it is in the commitments and contingencies footnote to the financial statement. So the information's there. It's just one would think that if you're doing a balanced presentation and you're doing the positive and the negative, that you would include a little bit more negative information when it exists.
Thank you, Naomi. My question is, in your opinion, in the future, do you think we should see more environmental reports prepared in the format of a review or a format of the audit? In other words, do you think the reports should be prepared with opinion or simply a presentation of basic facts? Thank you.
I think it's going to, well, as long as they're voluntary, I think that it's going to depend on the company. So if you're in an industry that has a huge environmental impact where people are really, really concerned about it and want to have credible disclosures and have it be demonstrated that the disclosure should be credible, then it will be audited. For other companies, it's going to be less important. for them to have it audited, and it can be of huge cost depending on how deep the audit goes. So, they're going to do a cost-benefit calculation to see whether it makes sense. But I think you'll continue to see kind of a range, particularly as you move down to smaller companies, as the population of reporting entities grows. It's not going to be the big firms that have a huge bang for the buck in doing the audit. If it's required and it works its way down, it's unclear.
Okay, well, any further questions you might just like to address to Naomi at refreshment? I'd just like to now call on Paul McInerney from CPA Australia, who will do the closing address.
Thank you, Professor Lyne. On behalf of CPA Australia and the University of Melbourne, I warmly thank you all for being here tonight. CPA is thrilled to once again join with the University of Melbourne to present this annual research lecture. As we've heard, it's the oldest continuous research lecture series to be held anywhere in the world, an achievement for both organisations. Since its origin in 1940, this lecture has proven to be an invaluable platform for the latest of thinking and research in accounting and finance to be shared and discussed. CPA Australia is particularly proud of this long-standing tradition and delighted with its ongoing partnership with the University of Melbourne. At the heart of this relationship is the belief that education empowers people, helps realise their potential, ultimately leading to the advancement of the accounting profession. The history of CPA Australia is one of initiative, innovation and change as markets, economies and technologies change. It is the commitment to integrity and learning that lies at the root of the CPA Australia designation and provides the strength for a professional code of conduct, dynamic evolution into the future. The CPA designation is recognised and valued throughout the world. CPA Australia delivers access to premium education, training, publications and resources to all members, wherever they live, in whatever industry or sector they work, and wherever they are in their professional career. Ladies and gentlemen, on behalf of CPA Australia and the University of Melbourne, thank you to Professor Naomi Soderstrom for your presentation and insights this evening. I now invite Professor Paul Kaufman to present Professor Soderstrom with the University Medal. Thank you, Professor Kaufman and Professor Soderstrom. That concludes the formal part of our proceedings this evening. I invite you all present to join with us for refreshments served in the foyer outside the theatre. Thank you.